Good morning, or good afternoon, I should say, everyone. Thank you for joining us for the Defiant Weekly Recap. As always, we are here with most of the Defiant printing. We have Alex and Owen, staff reporters here at YYC Trader, our head of news, and myself, the founder of the Defiant. And we will review all the major headlines that happened throughout the week. Some of the biggest talking points I will go over is the CFTC goes against CZ and Binance, the biggest crypto exchange. There's news on staked ETH. Withdrawals will be available and live in 2 weeks. So exciting for the Ethereum community. There were ZK-EVMs were on fire this week with at least, I think, 3 different launches. So this is this competing flavor of rollup scaling technology. The Euler attack hacker continued returning funds. And we had a few great features by our reporters, one on DAO and governance token legal risk, another one on how smaller projects were using the Arbitrum airdrop. So yeah, lots happening this week. And before we get to it, I want to thank our sponsor for this week's weekly recap, Arch. So further ahead in the video, we'll show you how you can securely borrow against your crypto assets with Arch. So thanks again for sponsoring the video, and a shout out to potential sponsors out there. Give us drop us an email or a message if you're looking to get your message out there together with us. So let's head to our biggest topic of the week. CFTC sues Binance and CZ. Alex, you covered the story, covered the market reaction, which was surprisingly muted. So if you want to walk us through what happened.
Yeah, you'd think that there would be more, more of a splash in the market after a U.S. regulator goes after the biggest crypto exchange in the world. I saw an estimate this morning, actually, that Binance handled 90% of crypto spot transactions in 2022. So it's like, Binance is the crypto world's equivalent of too big to fail. But the Commodity Futures Trading Commission in the U.S., so that's one of the financial regulators. The other big one is the Securities and Exchange Commission. You've been hearing more about that one this year, but the CFTC on Monday sued Binance, sued its founder, Changpeng Zhao, CZ, as everybody knows him, former Binance executive, a guy who used to be the chief compliance officer. And it, in a nutshell, the CFTC alleged that Binance was that Binance was allowing Americans to use its platform. So there are certain trading platforms that retail investors in the US aren't allowed to use, ones that offer risky derivatives. If you were an American and you used FTX, it was likely FTX's US arm. The reason being that FTX International, like Binance, would offer more exotic, riskier trading strategies to its customers. And in the US, if you're retail, you're kind of limited to regular spot trading, right? So US customers aren't supposed to be using Binance International. The CFTC is alleging that almost 1/5 of Binance's trade revenue actually came in years past from Americans, that Binance knew Americans were using its platform. And not only did it know that they were using its platform, but it kept its onboarding process intentionally lax so that it wouldn't cut off that flow of American dollars. that it even encouraged Americans that it knew shouldn't be using its platform to do so, that it gave them it gave certain VIP customers bespoke advice on how to evade its onboarding checks, that it put out, kind of like wink, wink, nudge, nudge guides on its website about how you might be able to access foreign websites like Binance.com using stuff like a VPN, right? So that's the heart of the CFTC's lawsuit. There are other things that it alleges in there. It has a bit about Binance trading accounts. Some people saw that in the lawsuit and took that to mean that Binance was trading against its own customers, something that it's vehemently denied. Allegations that Binance not only knew Americans were using its platform, but that like Hamas, considered a terrorist organization by the US government, may have also used its platform. And for that reason, a couple of legal analysts think that, okay, the CFTC lawsuit came out, the allegations doesn't look great, but it's not super, super nefarious the way the FTX allegations are. But they think that these might be followed by criminal prosecution from the US Department of Justice or something of that nature, right? So anyway, all that's to say, the initial allegations, they're serious, but it seems like the markets understand it's not that serious, right? So looking at on-chain data, the amount of money flowing out of Binance, the centralized exchange, has been kind of muted. It's only been about like $1 or $2 billion since the lawsuit dropped, which sounds like a lot of money, but Binance has like 70 billion sitting in cold storage, if I'm not mistaken, right? So it's like 1 or 2% of the actual assets that Binance holds on hand, and actually outflows from Binance have been way higher, even just this month for different reasons, right? So people aren't fleeing the platform because they're nervous about this lawsuit. They aren't even really fleeing BNB, the blockchain that Binance built, according to DeFi Llama, which tracks the cumulative amount of crypto in applications on BNB. It's fallen this week, but the amount of crypto locked in just about every blockchain has fallen this week. BNB's has fallen maybe a little bit more, but not enough to indicate any kind of run to safety. The only real sense in which Binance took a hit that's really, I guess, deeper than other cryptos has been the actual BNB token, which powers the BNB blockchain. Last I checked, that's fallen like over this past week 4 or 5%, which is a lot steeper than other top 10 tokens.
Yeah, but as we see here, it's still higher than it was just 30 days ago. So you see there,
right.
When the news broke, there was a big leg down. It's been recovering since, but the decline wasn't so steep as to even reverse, the past 30-day gains. So yeah, I also thought it was interesting that, sure, that there was some reaction in the market. The token fell. There were some outflows to the centralized exchange and to the Binance smart contracts blockchain, BNB chain, but it wasn't anything huge. Like, it wasn't something that would indicate that most people are fleeing Binance and Binance related products.
No, people saw the news.
Flee, right?
Say that again?
I said, where do you flee? If the banking system's collapsing, who do you trust more? JP Morgan or CZ?
The tough call. Yeah.
I'm trying to think how did Coinbase's coin stock, did that drop? That dropped like a rock when Coinbase got the Wells notice, right?
True. Yeah.
Yeah, well, I mean, because we don't know exactly what the SEC. So in that case, the SEC was saying that it intends to sue Coinbase. It hasn't actually sued them yet, the way the CFTC did with Binance. But what Coinbase thinks it's going to get sued over is more existential than what Binance is facing, right? Binance is just like, oh, you let some people who weren't supposed to use Binance use Binance. The CFTC is supposedly going to sue Coinbase, saying something to the effect of a lot of the tokens on your platform are unregistered securities, which kind of gets to the very like question of like, what does the American legal system think crypto is? You know, how strict is the scrutiny of these assets going to be? And that's more fundamental.
That makes sense.
It kind of gets at Coinbase's entire business model.
Yeah, I mean, it make like the Binance thing. It's like it could almost just be like some streaming service that people weren't supposed to access. I mean, at a very high level, it could just be like, oh, you used a VPN to like whatever, watch like I don't know, an Indonesian television show or something that you weren't supposed to. So, yeah.
I think like to me, what was super interesting about this case was seeing how all the at least a lot of the communications inside of Binance were leaked. So I mean, just like this is a side note, but they were supposed to be talking on Signal, and they were still leaked. So that makes me question, like, how safe are those?
It makes me question whether I have to go back and delete all of my Signal chat. I convinced all of my friends to use it.
Yeah, but what was crazy was that in some instances, CC was like, or actually the documents said, CC said in a message that was set to auto delete. So it was like, how did they get these messages? But in any case, that's a kind of side note to like the actual content of what was being said.
Yeah.
And it was just crazy how just purposely they were trying to skirt US regulations. It was just like very blatant. If those messages are true and allegations are true, etc. But they were basically saying, you guys need to find a way to get the whales in the US to trade on the platform. Like, tell them to use a VPN, whatever. Like, it was just very, they were clearly doing this according to those messages.
Right. According to those messages, stuff to the effect of, Americans are using our platform. They shouldn't be, but CZ wants them here because we make a lot of money from it. So make sure that, like, give them the white glove treatment. Someone had trouble accessing our website. They're a big customer. Can you help them evade our, weak or our purposefully weak KYC onboarding process? It's that blatant. It's
It seems like very unprofessional, but it's also just a business decision in the end. I think it came down to, CC saw the risk of getting caught doing this, but he also saw the profits of allowing US traders to use Binance, and he said, he decided to take that risk and pay the fine if there was a fine, or go through the legal process if there was one.
I mean,
it was just a very kind of,
gets at the very, soft touch regulation that a lot of financial companies in this country face, right? Like, financial firms, traditional financial firms, get multi-million-dollar fines, it seems like, every other year, and they're like, that's cool. We made more money off whatever low-level scam the government is just accused of stuff. We'll pay the fine.
You see that it's not so different from KYC AML for big banks. Like I don't know how many millions of dollars in fines like Credit Suisse has paid for like reaching some AML procedure. You know, they
Right.
do that all the time, and I think it's a business decision, just like Binance did, because they decide to go after kind of these profitable business lines, if you want to call it, than not.
Yeah, and the lack of price action, I mean, change maybe suggests that was almost baked into the market, as people kind of broadly maybe knew this already or didn't, I mean, at least don't perceive it as a huge, like, novel thing to update their positions
there was
with.
this meme. Let me know. Let me see if I can find it quickly. It was like, okay, here it is. I'll pull it up. But it's like the CFTC says Binance is sketchy, and like all of crypto Twitter is like, yeah, we know.
Yeah. That's what I was getting at.
Yeah. So
I mean, there's the demand side too, right? US traders want access to Binance because you can't access anything good being in the US otherwise. Like you can't use DYDX, you can't use perpetuals on most platforms. You can't access so many coins that are the hot ones that pump a lot, right? So these things get listed on Binance first. So, I mean, however tight your geo blocking is, people who want to get on will find a way. So I don't think, like, obviously, in terms of big clients, yes, they were actively quoting them, or it looks like from the documents. But your small retail guys, I mean, they would have found their own loopholes to trade anyway. You know what I mean?
I don't know, man. Hulu always seems to knows when I'm using a VPN. Like,
really?
Always. It's like, you're using a VPN. I thought the point
You're not
of
a
this was
hacker,
that.
Alex. You gotta add a couple layers of spice to that,
Yeah. I need to download Tor. You're right.
Yeah. Anyways, but YYC, I get your point. Yeah, that obviously there's demand. It's not just Binance making this available to people. There are traders large and small who are using VPNs and other ways to get on Binance.
Yeah, and I think you're right that people will find a way always.
Yeah, I mean, you have places like Bybit where you can still open an account with no KYC and trade perpetuals, etc. Right? So, like you said, it's a business decision because you can't compete in the bull market unless you offer all kinds of products that people are looking for, right?
Something that's worth pointing out, though, and first of all, if it wasn't clear when I was talking earlier, these are all allegations. The fact that the KYC may have been lax, that the executives at Binance knew this. It's just allegations, right?
Sure.
We don't actually know that to be true. Maybe crypto Twitter knows it to be true. We don't know it to be true. But almost all of the allegations in the complaint date to 2019, 2020. There are a couple things that come after that. But reading between the lines, it seems like if that is in fact the case, that it was much more of an issue like pre-pandemic than it is today at Binance. So it could be that they really tightened up their KYC in the years since.
Totally. They hired a lot of lawyers last year. I think I wrote a story. I remember they like bulked up their law team by significant amount. I think like at least 10 people or something. So yeah, they might have known something was coming, and they may have been, to your point, buckling down since then.
Yeah, worth noting that it was for a period that was, a couple of years ago. And I think, it's worth putting this into the broader context of how we've just seen an increase in just regulatory actions against or around crypto in the past couple of months. So, there was the Coinbase Wells notice. There was Kraken, which had to take down its staked ETH product, and there were actions against even DAOs, which Alex will talk about now. So it comes amid this climate of what it seems to be just a crackdown on the crypto industry broadly in the US. We've talked about this before. There's a question about whether it's a coordinated effort by different US regulators to clamp down on the industry. There was this headline yesterday about Elizabeth Warren recruiting an army to attack crypto. That was kind of within this like longer video, but still, like, she's definitely proud of that portrayal. So we have this climate of the US becoming just more I guess the US becoming less crypto friendly. So and then that's where kind of this Binance lawsuit comes in. So about this risk to DAOs, which is interesting because since kind of the beginning of DeFi and even before then, because DAOs predate DeFi, there was this kind of understanding in crypto that if you were a part of a decentralized autonomous organization, there would be less risk for regulators to act against your organization, because these DAOs live online. They aren't registered usually under any jurisdictions. They're not legal entities.
There's no CEO.
Sometimes
the buck doesn't stop with somebody.
Yeah, there's like the organization it's not like you have a structured corporate team around it. These team members are usually or many times anonymous. So all of those things were meant to protect those participating in DAOs against any regulatory action. And it was like, the decentralized, the better. That way crypto can actually be this alternative financial system without having to comply to regulations in different jurisdictions. But that's come under question recently. And so BZx, which then turned to UkiDAO, was the first example of this, of a DAO getting sued by a US regulator. And so that sparked a lot of questions in the space. Alex, you wrote a really interesting story on the implications of this. So how, do DAOs face regulatory risk?
Maybe. So BZx DAO later became UkiDAO, which a lot of people heard about last fall because the CFTC sued UkiDAO. If I remember correctly, the allegation was you were offering certain trading products that only registered companies can offer. You should have registered. And UkiDAO actually settled and paid a fine, if I recall. But this case here is a class action lawsuit or a putative class action lawsuit filed against BZx, against the entity before it rebranded to UkiDAO or whatever. And kind of like the history of this is BZx, the protocol, is a trading protocol founded by these two guys whose name I don't recall off the top of my head, but they built the protocol, and they also formed a company, I think it was BZx LLC, that owned or managed the protocol. And then at some point a couple of years ago, they transferred ownership of the protocol to the community, to a newly formed DAO. People who owned BZRX tokens would now collectively be the owners of this protocol, typical DAO stuff, right? Like you've got governance tokens, you get to propose changes to the platform, you get to vote on the proposals. And on a call detailing this transition, one of the co-founders said, well, we're seeing these builders getting slapped with lawsuits, and we want to future-proof ourselves. We want to make it so that if a regulator comes to us and says, we're serving you because you violated this whatever, that, well, there's nothing we can do because we don't own it anymore. Kind of everybody owns it. It's distributed. It's censorship resistant. It's not subject to the laws of the land. That plan isn't going super well. On Monday, and more of the history, right? That happened, and then just a couple months later, one of the developers for BZx, the now decentralized BZx, got an email, clicked on an attachment. It turned out there was malware there, and BZx, which existed on 3 chains, Binance Smart Chain, Polygon, and Ethereum. There were some security measures on Ethereum, so the money there was okay, but like all of the money in the protocol on both Binance Smart Chain and on Polygon was drained by the hacker. It was like a total of $55 million worth of crypto. So the 19 plaintiffs in this lawsuit that I mentioned, they cumulatively lost I think $1.7 million worth of crypto. But in their lawsuit, they're alleging that the token holders in BZx DAO are general partners. As such, they're liable for this money lost, that they had a duty to the customers, the people who were using the platform to keep the crypto safe, and they were negligent. They were negligent in upholding that duty. As such, we're suing them for, we want our money back, basically. So on Monday, a judge rules that yes, that's plausible, basically, right? Like the defendants had asked the judge to dismiss the lawsuit, saying, we're just members of a DAO. We might have founded the protocol, but, we're just members like anybody else. We don't have any particular responsibility over this protocol. We don't have any custodial role in the platform, right? So judge, could you please toss it out? The judge says, no, the allegations seem plausible, so I'm going to let this move forward. And the judge gave his implicit kind of blessing to this argument that, yeah, if you owned one of the governance tokens, you're a co-owner of this business and you're not protected from any liability that the business might incur. So
that means that any token holder for any participant in the BZx DAO is liable.
Now, the judge is simply saying that's a plausible argument. So now I'm going to let the two parties, they're going to have a discovery. They're going to ask each other for records. They're going to argue this in court. That actually hasn't been decided yet and probably won't be for a couple of months. But the fact that the judge thinks that kind of makes sense. Now everybody's watching this case to see what that final judgment looks like, right? Because spoke to one attorney who has DAO clients who was basically saying this is terrifying, right? The idea that just owning a governance token could kind of thrust you into this business classification that it's like I could just send somebody a governance token. They don't have to on their end accept that transaction, right? When you dust people's wallets and you send them tokens that they didn't want in the first place, it's like could you just send somebody a governance token and all of a sudden poof, they're a general partner in a business?
Well,
also, in theory, if you own Maker tokens, in theory, you could participate in governance just by holding those tokens. Would that make any Maker token holder liable if, MakerDAO gets sued? It seems so crazy.
Right. And so
Like it shouldn't be.
something that the judge mentions is the fact that while actual participation in governance might be the kind of like the line between, are you a general partner or are you not, right? It's one thing to just passively hold governance tokens. It's another to be, active in the community, making proposals, voting. And that could be the dividing line, right? But that's also kind of problematic in its own way, right? It's like, what's the cutoff point? Like, oh man, I voted once a couple of years ago, and so now I'm considered like a co-CEO of this random protocol. Like,
Well, and crypto's had enough problem with people participating in governance, and now, like, if we're going to disincentivize that, I mean, just from a pro crypto governance standpoint, that's not the best.
No.
Right. And now one thing that I'll point out is that speaking to attorneys, they did all mention, like, okay, the notion that members of a DAO could be general partners, that's not new. That's not surprising. Honestly, like, that doesn't worry us. Like, yeah, so when the SEC brings lawsuits against these crypto companies as it has this year and says, hey, we're suing you because we've decided that your token, whatever it might be, is actually an unregistered security and you're breaking the law, crypto attorneys will wring their hands and say, well, where was that rule? You had never told us that. You're making up rules as you go along, as you file lawsuits. When I spoke to attorneys here, they weren't saying, oh my God, how could this judge think that DAO members are general partners? That's crazy. It's like they were kind of saying, well, like most DAOs are decentralized in name only. They're masquerading as distributed businesses when in fact they're kind of like any other business. There are a few people who really run things, and just because they gave people a token and let them vote in a snapshot poll doesn't actually mean that they're meaningfully decentralized. And it's not outrageous for a court to say, yeah, you guys are actually general partners in this business and you are legally liable when something goes wrong. You
have a great quote here. It's like this makes that point, right? People in the industry conflate decentralization with trustlessness. Just because there are lots of members in the DAO, that doesn't mean that the protocol itself is trustless. If one developer can get hacked and the entire protocol was drained on 2 separate chains, that's pretty indicative that this was not a trustless system.
Yeah, this is all happening because one dev had his crypto wallet hacked, and the hacker was then able to take all of the money out. Like, if one person who helped build the protocol
controls
could
that
take all the money out and simply chooses not to, right? That's, to me at least, and the attorneys to greater and lesser degrees kind of agreed with this, that's decentralization theater. That's like, they're not actually meaningfully distributing power and control of the protocol.
So this lawsuit, sorry?
I said that's why Chris Black hates multi-sigs, right?
Oh, right.
It's
Exactly.
4, 5, 6 people who can potentially rug billions of dollars if they want to, or even against their will. Like, let's say you go to a Polygon conference, right? Most likely, most of the Polygon multi-sig would probably be there, right? So potentially some, James Bond-esque operation could be planned, and take them all and
just get a white van, man. Yeah, it's all good.
Ocean's 11 style.
So I guess like the bigger lesson here for people in DeFi is that it's not that DAOs are liable is that fake DAOs are liable. Like, I don't, I think the idea here is that if your DAO is actually not decentralized and controlled by a handful of devs, that really is just a traditional company. It's not actually a DAO.
And it's one other thing that I'll note here is just there are obviously kind of like levels to decentralization, right? So Eric Dialis, one of the attorneys that I was talking to, is saying, well, when this DAO, the governance tokens, when people vote, is this vote on chain? Do the proposed changes self-execute such that when the DAO speaks, the thing they voted on just happens? Or is it more like the tokens let you participate in a poll, and then the outcome of that poll directs some multi-sig, just like a couple people, to then execute the proposed change on the DAO's behalf, because that's less decentralized, right?
Yeah.
Or is it just like, oh, I get to chat in a governance forum and make my voice heard, and it's really there's just one person who has the keys to the whole contract or whatever. So it's like, it makes me think about how when Arbitrum announced its token drop and how it was handing control of the blockchain off to a new Arbitrum DAO. They really talked up the fact that DAO votes there would be self-executing. One thing to consider for people creating these distributed communities.
Yeah. And before we move on to the next story, I just want to go down memory lane for a little bit, because I was remembering that BZx was the first. It was the first kind of major hack. I mean, a hack to BZx was the first major hack that happened in DeFi, and I covered it on the Defiant newsletter when it was just myself, like just me writing it every day. So here's the ARBs exploit DeFi to make 900,000 in seconds, which seems like such a small hack by these days standards, but back then it was the biggest hack ever in DeFi. And it was just like such a big deal. And I made this whole diagram on like how the hack had actually happened. It's just like it was like a flash loan and like all these like complicated things. And even back then, there was this question, the D in DeFi, and I had written, this is February 2020. Critics say a DeFi platform which can be paused by its management team at will isn't decentralized at all. So Charlie Lee said most DeFi can be shut down by a centralized party, so it's just decentralization theater. So it looks like we haven't come that far in 3 years. Still here.
And that isn't even the hack that's being discussed in this lawsuit.
Right.
That hack happened in 2020, and then the big one, the $55 million one, happened in 2021, and that's the one that people are suing over. So,
no,
so nothing changed, just the rugs got bigger.
Exactly. Oh, so crazy. BZx just, it just kept getting hacked. Here's like hack number 1, Valentine's Day exploit. Hack number 2, Sunday Scaries exploit.
And one of them is a phishing exploit.
Oh my God. At least these ones here were somewhat sophisticated. They involved this, flash loans and. Anyways, so here's another DAO, MakerDAO, trying to become more, censorship resistant. So they are, they've been pushing to become more and more decentralized. So I think it was last year they dissolved the Maker Foundation, which was a Switzerland-based foundation a la Ethereum. And now they are trying to decentralize the collateral that is backing DAI. So this is a proposal that passed to ratify a new constitution, which was proposed by Rune Christensen, the MakerDAO founder, last year. It's called the Endgame plan. And the idea is to become resilient against any kind of government, regulatory, or otherwise, attack. And so, yeah, what's kind of behind this plan at the core is that right now, or I should say in the past several months, Maker strategy has been to increase its to diversify collateral for DAI. So it had been accepting real world assets to back DAI. There was this like big push towards real world assets, and that's because the way that DAI, the stablecoin, can scale is by allowing collateral that can grow. If you're just using ETH as collateral, then you're limited by ETH market cap to how large the stablecoin can get, and actually less than ETH market cap because this is over collateralized. So there is kind of a cap on how big DAI can get if it just relies on ETH and other crypto. So that's why they had this push on diversifying collateral to centralized stablecoins and real world assets. It's how a large chunk of DAI collateral became USDC. But we saw the risk of this become very apparent in 2 weeks ago when 3 banks in the US went down. One of them was holding USDC collateral. USDC lost its peg, and so then DAI became just as risky or about as risky as USDC. So in a scenario where DAI, which was the original decentralized stablecoin, was supposed to or should have come out a winner of like people losing trust on centralized stablecoins, it went down, just as much, as USDC. So anyway, so this endgame plan is a push to fix this and make more of DAI collateral decentralized. So I think it's a pretty significant move. It won't be immediate. Like there are different steps that Maker has to take to do this. But this is kind of the new direction of DeFi's second largest protocol by TVL. So I thought it was a super interesting development. And just on a personal note, I think it just makes sense for DAI to go back to its roots as an actual decentralized stable.
Yeah, and it was like a personal battle too. I know like Rune was involved like pretty heavily in pushing for it, and I think a lot of people were not happy with the direction. I'm not super up on the details, but
yeah, exactly. That was a bit controversial there because Rune controls a big chunk of Maker tokens, and so he was pushing for this to happen. And there's also delegates that vote, that hold part of Rune's tokens that vote however he votes. And Sam wrote the story, and he has here in the story that if it wasn't for Rune and his delegates, the endgame plan, like this new constitution, wouldn't have been ratified. So speaking about kind of lack of decentralization, that's a red flag. That was basically one voter swaying the entire vote.
Yeah, I think DAI has kind of no one knows what DAI's kind of mission is anymore. It's no longer you can't call it a purely crypto native stablecoin anymore, right? Because we've seen with the DPEG and USDC making up such a big portion of collateral. When it started out, it was the lending protocol, but now others have come in and innovated, come up with different models. Liquidity, for example, sticking with the pure ETH thing, which is, in terms of the current headlines, yeah, it's a great move, and they've seen a boost. But is it scalable? That's again the question that they face, right? Because that's why Maker started this whole USDC PSM in the first place.
Yeah, that's right. Yeah, that's a trade-off. it becomes less scalable if you're limiting yourself to one type of collateral. Before we move to the next headline, which is the Ethereum upgrade, I'd like to give another shout out to our sponsor Arch, which allows you to borrow against crypto. So yeah, thanking Arch for sponsoring this weekly recap. I think we will see a short video on them.
Seamless loans for alternative assets. Introducing Arch. Arch enables you to obtain a single loan collateralized by your combined crypto holdings, all held securely and untouched by the #1 SEC-regulated crypto custodian, BitGo. Choose between loans denominated in fiat US dollars or USDC stablecoins and experience the confidence and flexibility that Arch provides to alternative asset investors.
Nice. Thank you, Arch, for sponsoring our weekly recap. And now let's turn our attention to Ethereum and how ETH stakers will be able to withdraw their ETH in just 2 weeks. Owen, can you tell us more about this development?
Yeah, so this broke a couple days ago, and the high-level takeaway is that Ethereum, which has been staked and hence locked for a maximum of like 2.25 years, will start to be able to be unlocked on April 12th. And so, you know, as probably a lot of people watching know, the beacon chain was I believe it's the consensus layer for Ethereum's transition to proof of stake, which has been, people have been staking Ethereum in starting, I think, in late December 2020. And basically it's been a one-way road where you deposit your Ether, you're getting a return, but you haven't been able to withdraw them. And so now we're finally seeing, as you know, Ethereum's kind of somewhat epic progression, you'll be able to unlock starting on April 12th. Very big news. I mean, the big thing to know also is that the selling is progressive. I think it's something on the order of like 200 or 2,200 ETH per day will be able to be unlocked. So
there's a queue.
Yeah, there's a queue. Mm-hmm. And yeah, so that's important to know. So you're not going to get a huge amount of sell pressure if you think a lot of people are going to sell starting April 12th, but there will be a progressive increased amount of ETH sloshing around the crypto ecosystem starting on the 12th. So yes.
Around the time of the merge, I remember reading that queue, in the event everybody immediately tried to withdraw their stake, that queue would take more than a year to work through.
Oh, nice.
So, yeah, not like it not much of a possibility of like, you know, a couple $1 billion getting dumped onto the market all at once.
Right.
I don't know, but what do you guys think? Do you think this will increase sell pressure on ETH, even if it's this kind of slow drip? But if you have just like constantly stakers taking out their money, selling it, or is staking ETH still a better alternative yield wise than other places out there? Like maybe not, maybe it's not worth taking out your ETH.
Yeah.
I don't know.
Yeah, I mean, someone said, I think that you'll have, you know, diehard holders or, you know, supporters of ETH are going to be the ones who staked. I mean, that's not obviously across the board, but like the composition of people who, especially like natively staked in the withdrawal contract, like they themselves did it, not through a Lido or a Rocket Pool. Like they're not your average ETH holder per se, looking to like flip on like a month or two timeline. So, I mean, I mean, that's definitely on the side of the factors of mitigating whether people are going to sell. That
Right.
said, it's still 2,000 ETH a day. So
Yeah.
I hope they sell.
To
They
buy
could,
lower.
yeah.
Mhm.
yeah, we'll see.
What's the yield like right now
It's a good
for
question.
Staking
staking?
yield, I think it's about
Yeah.
5%.
It's pretty decent.
Yeah, and it's more if you go through Lido or Rocket Pool, for example. The 8 ETH mini pools, I think, yield close to maybe 7.5, 8. So
Is that because of the token incentives on top?
I haven't dived into it in detail, to be honest, to figure
Sure.
out where the extra yield comes from.
Mm-hmm.
But yeah, it looked attractive. I was thinking of setting one up just, to say, I have a node.
Yeah. Savio said, just there won't be much sell pressure on ETH. You wouldn't stake it otherwise. So yeah, I think there's definitely something to that. So
Yeah, there's like
Yeah.
more kind of ideological component of
yeah,
wanting
if you're
to be
willing
a
to
part
bet
of
on
the
it.
network. Yeah.
Yeah, and if you're going to bet on it for 2 years, like you're probably pretty hardcore anyway. So
Yeah.
I mean, at the time, we didn't even know it was 2 years. It was just sometime in the
point.
future, right? It was basically handing off your ETH and saying, all right, we just we trust in the team and let's see what they do.
Yeah, good point. It was even a bigger leap of faith than knowing it was going to happen at all. So yeah, fair point.
It's notable that the Ethereum devs keep delivering. They they may be late with a lot of it, but they've actually pulled off so many of the things that others said weren't going to happen. So all through this time, there was this kind of chorus of Bitcoiners or critics saying that ETH was going to be locked there forever. But now apparently in 2 weeks, you'll be able to withdraw it. Same thing with like the actual transition to proof of stake. We reported how it went, how it happened without any issues. So, I mean, this is, I think, another testament to Ethereum devs delivering, even if, not in the most timely manner, but they do deliver in the end, which is worth noting. Okay, we're running out of time and we have a bunch of headlines to go through. So, related to Ethereum, there were lots of layer 2 related headlines, Owen. With like ZK-EVMs going live.
Yeah, I can just speed run. So yeah, I mean, we saw Polygon's zero knowledge rollup go live on mainnet on Monday, and as anyone following crypto knows, the push to develop real zero knowledge rollups has been massive, and we saw ZK Sync go live on Friday. And the basic idea is that transactions will get cheaper and they'll get faster, and zero knowledge is kind of touted as even superior to optimistic rollups, which have currently dominated the Ethereum scaling space. And in line with that, Consensus, which is a huge conglomerate kind of built up around providing various products and services for Ethereum, also launched a zero knowledge EVM or a test net for one this week. So that's part of a huge theme for the year, which has been this kind of ZK-EVM rush, which is very interesting. And I think, I'm working on a story now kind of delving into kind of what this is about, and I'm curious what investors are chasing and how it's going to manifest. Or what are they betting on, and why are there so many providers? You could arguably say there's kind of a race to zero if everyone is developing a zero knowledge roll up. I don't know where does the money come from exactly. Probably not a discussion for today, but
watch that story. We'll be soon.
It's a tough one. So yeah.
And then another good story that you did is this Arbitrum airdrop helping smaller DAOs survive the bear market. So yeah, if you want to just give the gist of that story, I thought it was really interesting.
Sure. So, high level, as we all know, Arbitrum dished out a bunch of responsibility to everyone, I guess 2 weeks ago, in the form of tokens, governance tokens. And that was 1.3 billion of a $10 billion supply. Was dropped across the community, and of that 1.3 billion, 8.9 were gifted to 137 DAOs. And so that was kind of a big deal, because typically you'll see airdrops have just gone to individual people and they sell or try to make yield or LP or whatever. But basically now all these DAOs have I think what is it, like, yeah, it's like over 150 million spread across them. So they're basically, I was kind of exploring, what does this mean, and what are they deciding to do, and how, kind of looking into their discords and seeing what their decision process is, and everyone's saying just give it to the community and airdrop it, and then also, like, yeah, you'll see smaller companies, and I realized, we went through kind of the top 10, and you realize that this company Cap Finance, which I think does perpetual futures, like, they tripled their treasury off this airdrop. So it's kind of it's just an exciting space to watch in terms of like, I don't know, you have all these DAOs, all these decisions don't matter, but like, you give them a chunk of money and suddenly everyone starts paying attention, and there's just a lot of activity around all these governance decisions, and like, should you use it for liquidity mining, or should you, I mean, some debate just like, should you just sell it for stable coins, because that's more stable than ARB? Should you try to become like a key governance player in the Arbitrum ecosystem? So yeah, it's very interesting to kind of see these debates live, and that is an exciting thing about crypto, is that you kind of can just hop in a Discord and you can see everyone, being various degrees of thoughtful or not about like this, $1 million windfall that potentially a small organization received. So
yeah. No, super interesting. And also, interesting about crypto is that you get these scenarios where you literally see kind of free money falling from the sky, and it's not pennies, it's like millions, several millions of dollars in some cases. In some cases, more money than the project even had to begin with. Just, they're getting it for free, or actually in exchange for building and participating in the Arbitrum ecosystem. So just really fascinating mechanics happening in crypto with airdrops as a way to incentivize and reward users. Yeah. So another interesting story we had is Cava. So here's a bit of alpha for those listening. Alex spotted this really quickly rising blockchain. Cava, you want to give a quick rundown of this one?
Yeah, so Cava's been around for a little while. It's not like I think it was the beginning of the year that we were looking at Canto, which was a relatively new blockchain that was taking off. Its TVL was just going up and up and up. It's since kind of come back down to earth. But Cava's been around for a while, but over the past month, the amount of crypto deposited in Cava has gone up by like 80%. So Cava's on fire right now, and the reason is that there's a new lending protocol on Cava, and it's built by the same team that built the top lending protocol on Optimism, Zona Finance. They just forked Zona and put it on Cava, and money is just pouring in to this new lending protocol, Mare. I think Mare's TVL is at like $130 million, which accounts for, I think, over the month of March, Cava's TVL has gone up by about 150. So that's 130 out of $150 million growth there, is all because of Mare. And what's interesting is that it's not just about that one protocol. It's the Zona playbook and Optimism. Zona doesn't exist in a vacuum. It's actually tightly integrated with the number one protocol there, Velodrome. That's a decentralized exchange that uses a particular model that was not popularized necessarily, but that was first cooked up by infamous DeFi developer Andre Cronje. And that particular model, the integration between the lending protocol and this DEX can create a kind of flywheel effect that Zona used to great advantage over the past couple of months on optimism. And that same exact playbook is being replayed here. Something that I'll be keeping an eye out for is kind of how long the party can keep going, right? Because this breakneck growth is probably going to slow down at some point. But it's been a great month for Cava. I mean, it flipped Solana. It's now, if I recall, the 11th largest blockchain measured by TVL. It surpassed Solana like 2 weeks ago. So,
right.
Yeah, crazy how one project can make or break these blockchains, these like smaller blockchains, and how quickly kind of after the top 5, I guess, the rankings can change, and I think it just speaks to kind of this game of musical chairs that degens play. They just go, liquidity just moves from one place to the next, chasing yield. And I think that ties well into this other kind of similar kind of story of just like a quickly rising project, Trader Joe. Owen did this one. I think I'll just run through the last headlines that we have, since we're over time. But Trader Joe is the fastest growing major DEX this year, after implementing a Uniswap v3 like model. So this model of having concentrated liquidity in bands of prices, they implemented it, and it looks like it's driving trading, but still not close to the highs that it had in trading last year. But still, this increase in trading is making it grow faster than other large DEXs. Then we had the Euler hacker continue to return funds in the NFT space. Disney is another big Web2 company shutting down its metaverse division. We had Instagram say they're dumping NFTs. Disney is doing that as well. But NFT space isn't dead. And we had this Oasis project launch a pop-up hotel, which is pretty crazy. You don't see NFTs do that every day. Then Teller V2 is offering fixed term loans, which is interesting in this volatile space to get anything fixed term against crypto. And then finally, Aave is launching on Polygon ZK-EVM. So those are the major stories that we covered this week. As always, lots going on. We're providing you the best and deepest coverage in DeFi and Web3. So stick around for next week and see what our headlines will be. I don't know, guys, if I'm missing anything that you wanted to add, or we can wrap up.
I would just say the Trader Joe people were very specific that the bins, that their liquidity model is about, they further divide liquidity into bins rather than the kind of these continuous bands of liquidity, which they argue, and I tend to agree, bring some advantages. So just shout out to those guys. They were just trying to say they're not just Uniswap B3.
They're not just copying Uniswap B3. All right. Okay. Sorry, Trader Joe. Bins and not bands. Okay. All right. Cool. I think we can wrap up. Thank you so much, everyone who joined, and catch us next week.
All right.
Bye.